Hey everyone, and welcome to Talk Tickers. This is where we slice and dice the earnings calls that really move the needle. And today, we're jumping right into Fluor Corporation's Q3.
All right, let's get into it. Fluor's quarter was, well, messy. On the surface, you had this massive earnings beat, but then a shocking revenue miss and a huge strategic change-up. But you know what? If you look past all that noise, management was sending a crystal clear signal about where this company is headed.
So let's start with the headline numbers. These are the figures that hit the wire pre-market on November 7th, and boy, do they tell a tale of two different stories.
So, on one side of the coin, you've got a fantastic beat on adjusted EPS. They came in at 68 cents, smashing the 44-cent estimate. I mean, that's a huge win. But then, you look at the other side, revenue. They missed by a whopping $800 million. That's almost 19% below what everyone was expecting. When you see a split like that, you know the market's going to scratch its head.
And that's exactly what happened with the stock. I mean, check this out. Pre-market, the stock just shot up over 7%. Everyone's excited about that earnings beat, right? But then, as the day went on and people started digging into why the revenue was so low, all that excitement just fizzled out. The stock ended the day up only about 2.5%. That right there tells you there's a bigger story under the hood.
Okay, so let's peel back the layers on that huge revenue miss. Because here's the thing. It wasn't what you might think. This wasn't about projects getting delayed or business slowing down. Nope. It was all about one single item that had nothing to do with their day-to-day operations.
And this is the key right here. The whole miss, pretty much all of it, came down to this $653 million charge from an old project, the Santos LNG project. Now, because of some quirky accounting rules, they had to book it as a reversal of revenue. So it's not like they lost the business this quarter. Think of it more like they're cleaning house, tidying up the books from something that happened a long time ago. It's not a sign that the business is falling apart today.
And honestly, this next chart shows you exactly why management isn't sweating that revenue number. Look at this. They are aggressively, and I mean aggressively, de-risking the entire business. 82% of their massive $28 billion backlog is now what we call reimbursable. That means Fluor is protected from cost overruns. And get this, 99% of the new work they won this quarter was reimbursable. That's not an accident. That is a very deliberate, very smart move.
So, this whole de-risking thing is just one piece of a much bigger puzzle. It feeds right into a major strategic pivot from management. They're not just sitting back and playing defense anymore. They are absolutely going on offense with how they're handling their money.
First up, NuScale Power. They're finally cashing in their chips on that long-term investment. And they've laid out a super clear three-step plan to sell off their entire stake. The goal? Be completely out by the middle of 2026. This isn't some vague promise, it's a concrete plan that's going to bring in a ton of cash.
So what are they going to do with all that cash from NuScale, plus the money they're already making? Well, here it is. They're targeting $800 million in share buybacks. Let me tell you, when a company announces a buyback that big, it's a massive vote of confidence. Management is basically shouting from the rooftops that they think their own stock is a bargain. And it's not just talk. They're backing up that confidence with cold, hard numbers. They raised their guidance for the full year, and not just on one thing, but across the board. We're talking higher adjusted EPS, higher adjusted EBITDA, and higher operating cash flow. That tells you the underlying business is really humming along.
Okay, so to really get why all this is such a big deal, you have to understand what's been happening leading up to this quarter. Let's be real, Fluor has been in the hot seat.
Just look at the last 6 months. Back in August, they had a really tough Q2, missed earnings, and the stock got hammered. Then, in October, things got really interesting. An activist investor, Starboard Value, showed up and bought 5% of the company. That put a ton of pressure on management to start creating value for shareholders. And boom, this quarter's news, the NuScale sale, the huge buyback, the guidance raise, that's not a coincidence. That is a direct, clear, and powerful answer to that pressure.
So that brings us to the big question. What does all of this mean for the stock from here on out? Let's talk about our take on what to expect heading into the next earnings call.
Really, the question on every investor's mind should be this. Is this strategic pivot, cleaning up the past and pouring cash back to shareholders, is that enough to keep the stock moving up, especially when some of their markets are seeing a few project delays? Here's what we think. We believe the market's focus is going to shift. People are going to forget about that one-time Santos charge and start looking at the real story here. We expect Fluor to hit or even beat the high end of their new guidance, especially as margins get better from their big project in Mexico.
We see their backlog staying solid, and we think the stock is just going to grind its way higher as the market starts to appreciate this new, shareholder-friendly strategy.
So when you add it all up, the solid operations, the new strategic clarity, and that massive capital return plan, it leads us to one conclusion. We're initiating our coverage on Fluor with an outperform rating. And our thesis is pretty simple, really. You've got a de-risked business model. You have a clear, powerful catalyst with the NuScale money funding that huge buyback. You've got an activist investor in the wings making sure management stays on track. And on top of all that, the raised guidance tells you the core business is getting stronger. It's a compelling story.
Just one last little nugget for you to keep in mind. The CFO, John Hina, he mentioned on the call that the tax benefits from selling the NuScale stock are starting to shrink a bit. Now, this could affect how much cash they actually get in the door. It's a small detail, for sure, but it's something the analysts will definitely be asking about on the next call, so keep an eye on that.
And to wrap things up, just the required notice.
This is not financial advice.